If you're a small business owner structured as an LLC sole proprietorship and you're paying yourself a salary, you're paying tens of thousands of dollars to the IRS that you don't have to, and also you're doing it wrong. My name is Alex. I'm a CPA with Stronghold Accounting. My background was auditing the financials of publicly traded companies, and now we help small businesses through our accounting and advisory services. And I'm going to talk about the right way to pay yourself as an LLC so you're not throwing money down the drain. The first thing we need to understand is that the LLC, limited liability company, not corporation, is a legal entity. This is to protect you if you were to be sued from a business perspective, so your personal assets aren't at risk, but it actually has no impact whatsoever on your tax liability. That is a huge misconception. I want you to think of the LLC like a chameleon because it can be taxed in so many different ways. The LLC can be taxed as a sole proprietorship if you're a single member, partnership if you have two or more individuals as part of the company, or a corporation, an S corporation or a C corporation. So the LLC is kind of like the chameleon of the business world, and the LLC is simply the legal protection layer. Most small business owners, once they're above $50,000 in profit, will elect to be taxed as an S corporation. So they're still the LLC legal entity, but they say, hey, IRS, I want to be taxed as an S corporation. And that is why you have an LLC legally and an S corp on the tax level. So how does this play into you paying your salary wrong? So if you are an LLC and you never elected to be taxed as an S corporation, what's considered an LLC sole proprietorship, right? You're probably a single member within the company, and by paying yourself a salary, you're overpaying on payroll tax. So to give you an example, if you're paying yourself a $80,000 salary out of your LLC sole proprietorship, when you don't need to, you're actually paying $12,240 in payroll tax to the IRS, and that is the worst part, is you do not need to. Now imagine that over 5 years. That's $61,200 you're overpaying. Absolutely nuts. So in this situation, an LLC as a sole proprietor does not pay a W-2 salary. So you might be asking, okay, how do I get paid? You get paid through distributions. Distributions are not taxed at all. So for example, let's just say your LLC profited $100,000. This is net income after all expenses, right? You are taxed on that net income of $100,000. So you're 100% owner, you're taxed on all of that $100,000. Now, if you distribute $60,000 of that, are you taxed on that additional $60,000? No, you're not taxed at all on that distribution. Only the net income is taxable. So making that adjustment from a W-2 salary to a distribution is going to save you $61,000 over the course of 5 years if you're in that scenario. Now, when you graduate to an S corporation, that is when you can run your normal W-2 salary, because that is when the IRS says you must have a reasonable salary at that point in time. And if you want to look for more guidance on this, check out strongholdaccountants.com/free consult. My name's Alex. I'm a CPA, and we help small businesses with accounting and advisory services. And like this, we also help with tax strategy and tax mitigation. So if you're needing unlimited guidance and you need a CPA in your corner that's going to be an expert advisor, check out the website. Be more than happy to talk with you and learn about your business. And again, hopefully you learned something from this and is able to save you a bunch of money. Thanks for watching. See you soon. Take care.